Right now, silver looks quiet, almost forgotten, and that is exactly when markets become dangerous. While everyone is watching stocks, rates, and headlines, silver is being pulled in two opposite directions at the same time. One force is real, physical, and growing fast. The other is paper-based, artificial, and built on promises. When these two collide, silver does not move slowly. It shocks people, and most investors never see it coming until it is too late. Silver today is no longer just a shiny metal sitting in vaults. It is inside your phone, your laptop, solar panels, electric vehicles, medical equipment, and even the data centers running artificial intelligence. Every push toward green energy and digital infrastructure quietly increases silver demand. The world needs more silver every year, but the supply is not growing at the same speed. Mines take years to develop, costs are rising. And many silver mines are actually secondary mines that depend on other metals to stay profitable. Before we go further, if you want calm, clear insights into real assets and hidden market risks, take a second to like this video and subscribe to Last Ounce Theory. It helps the channel grow, and it keeps you ahead of the crowd that only reacts after prices move. Here is where the story becomes uncomfortable. Most silver trading does not involve real metal at all. It happens on paper. Futures contracts, derivatives, and ETFs trade massive amounts of silver that do not physically exist. On paper, silver looks abundant. In reality, physical silver is much tighter. This paper system works only as long as most players never ask for delivery. Industry cannot use paper silver. A solar panel factory cannot accept a contract instead of metal. A medical device company cannot wait while prices are settled on a screen. They need real silver, delivered on time. As industrial demand grows, pressure builds quietly behind the scenes. The market looks calm, but the stress keeps increasing. At the same time, visible silver inventories in major vaults have been declining. Governments continue pushing electrification, renewable energy, and advanced technology. These trends do not reverse easily. Even if the economy slows, silver demand does not disappear. It shifts, but it stays real. History shows that silver does not give many warnings. It stays boring for a long time, testing patience, and then it moves suddenly. When confidence in paper markets weakens, silver reacts fast. Small changes in physical demand can create outsized price moves because the market is relatively small compared to global capital flows. This is why silver is different from most assets. It sits between money and industry. It reacts to inflation fears, currency weakness, and financial stress, while also being consumed by the real economy. That combination makes silver unpredictable, but also powerful when conditions align. The biggest risk for most investors is not volatility. It is being positioned wrong when the shift happens. When silver finally reflects physical reality instead of paper pricing, the move can be sharp and emotional. By the time silver becomes popular again, much of the opportunity is already gone. I am not here to hype overnight riches. I am here to explain pressure, structure, and reality. That is what Last Ounce Theory is about. Watching what is ignored and understanding why silence in markets can be louder than noise. Now I want to hear from you. Do you think paper silver can keep controlling prices, or do you believe physical demand will eventually force a reset? Drop your thoughts in the comments. If this video made you see silver differently, share it with someone who still thinks silver is boring. Your comments and shares help this conversation grow, and they help this channel bring clarity where most people never look.